And that music means that we are live here on YouTube. Coach T, Coach Matt, and producer Cody. Day after the Fed announcement, markets are still showing weakness and selling across the board. Utilities showing a little bit of strength. We're going to break it all down for you here on the halftime report. Matt, how you doing this morning?
Doing good, Tim. Excited to be here with the halftime crew and update everybody on what's going on in the markets.
It is a fascinating market. There's no doubt about it. We've seen some pretty good selling. After the Fed announcement, the market spun around, sold off. We talked about the risk of it yesterday during our halftime show. Today, more carryover through that. Let's start with a simple technical read, Matt. We are what most traders would say is pay range down. Is this a location where you're looking to take off bear trades? How do you read this thing technically?
Well, yeah, I mean, if you're looking to lock in some profit on some of those bearish positions you've had over the last few days, 3, 4, 5, 6 days, depending on when you were entering them on the breakdown of the markets. I mean, you would be looking to start locking in some profit in the short term. You are pay range down. I mean, you are overextended down in every single capacity, Tim. You look at the just from the pay range, Tim. You have not had a retracement. I don't count that as retracement. I count that as just a fading action while the market was at support. But you're looking at a market that has went from 2,800 all the way down to 2,480 without any type of buying behavior. And the most likely scenarios, we still continue to see some downward movements in price over time. But that doesn't just happen in a straight line down. Right? No bear market just has a straight line down. You have short covering, you have buying off the dips, you have the buy the dip mentality, you have valuations, so it doesn't just come straight back down. So yeah, I mean, as you're starting to get pay range down, you hit the ultimate low today of 24.63. I could see some people locking in profit, but as long as you stay underneath this support level at 25, now new resistance obviously, but old support level at 25.30, you're bearish.
All this is being attributed to the Federal Reserve, Jerome Powell's testimony, their decision to change their guidance, all that kind of stuff. You did a really good deep dive into one of the videos. And by the way, Cody, I'm looking at our YouTube channel, and I'm seeing 2 live streams going at the same time, market recap and halftime report. Double check on that. Let's make sure we're not accidentally streaming twice. Matt, give us your overall analysis on what the Fed did and how Jerome Powell positioned himself. I know we podcasted about it yesterday, but what's your take?
Yeah, and I did do that deep dive. So if you want to go out there and check the YouTube video I did yesterday, I posted on Twitter and Facebook and all that jazz as well, in the clubhouse, obviously. I just wanted to do a quick update on how the market reacted to the actual announcement. What the Fed did yesterday is they raised rates, but then they lowered guidance on the interest rate hikes coming into 2019. So there was something happening on Twitter yesterday. It was funny. I just laughed and laughed and laughed. There was somebody, and I don't know if it was CNBC or whatnot, but there was somebody who was talking about how that was a dovish rate hike. And I just want to be clear on something. There is no dovish rate hike. That's not how it works. So what the Fed did, what Jerome Powell did, is they announced that they are going to raise interest rates yesterday to 2.25 to 2.5 basis points. They are going to continue. They are then therefore going to lower guidance from the 3 expected rate hikes coming into 2019 down to 2 expected rate hikes. And Tim, what was fascinating in the marketplace, and I want to kind of relive it a little bit, what was fascinating in the market yesterday watching this is here's the announcement coming into it. So here's the price action coming into it. Here's the price action immediately following it. Okay. So and I want to talk about something very quickly, because as a day trader, we like these types of events. We like these types of volatile events that can drive markets fairly quickly one way or the other. And when I was a young trader, and I talked about this in the video, when I was a young trader, one of my mentors taught me how to do something called a K trade. And a K trade, and by the way, it would have got whipsawed on the S&P 500. But if you would have done it on the euro dollar, it would have been absolutely perfect here. But when you're looking at what is known as a K trade, it's basically you put an order in, and I'll just put some alerts just to kind of show you. You put an order in below a 5-minute neutral chart. So you have an order to sell underneath that, and then you put an order to buy above it. Right. And you have this kind of this, I put it there. So, the price is above it now. So I need to go price at or below. By the way, the Swiss increased interest rates for the first time in 7 years.
Are they off the negative stance?
Not negative. No, not yet, but they did increase it.
Hmm.
All right. So anyways, you have this situation here where basically if you see it explode one way or the other, it basically ticks you into the trade. And as you can see, boom, just drives it down, 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 and down. And that would have been a perfect K trade. However, the problem with that trade, especially over the course of the last 5, 6, 7 years, is high frequency trading systems and whatnot really kind of dominate that initial price movement. And I'll kind of show you right here on the S&P 500. So here, there's the announcement. Within 1 minute, Tim, not even 1 minute, price ticked all the way up to 25.90, literally 20-point price appreciation. And Tim, I was watching this on the 1 minute chart at the time. It was literally in like 2 seconds. Like 2 seconds, it had driven 20 points. That's not humans clicking buttons. That is high frequency trading systems just automatically pricing in certain things. And it creates this really, really volatile condition where it's like, oh my goodness, boom, I don't want to trade in that condition because I don't want to get just nailed and whipsawed by these algorithms and these high frequency trading systems. And so what happens next is you have this secondary movement. And that's what I've been talking about recently when we talk about these types of economic events, is you don't trade that initial price movement, you trade the secondary price movement. And as you can see here, then you fall by this big, big downward movement in price. Now, as you can see, it's coming right back up in to that exact same support channel right there. So it comes back into the intraday support channel. And then what happens? Well, what happens is this. You get the secondary move. And that secondary move happened right when, and this is the coolest thing about trading, is because we know when these things are going to happen. That secondary movement came out right when Jerome Powell started speaking. It wasn't the actual announcement, Tim, and this is what I want to be very clear on. It wasn't the actual announcement of an interest rate hike that drove this market. That's not what drove this market. And I know that's what all the headlines out there say. I know if you go read Reuters, Bloomberg's, the Times, if you go read the Wall Street Journal, if you read CNBC, any of those, right? They're gonna basically state that, well, they raised rates and they were more hawkish than the market expected in 2019. And there's some truth to that. But it was when Jerome Powell started speaking that the market really started spinning out of control. And when he started speaking, it was based on a couple different things. Number one, and I am well on the record that I do believe we should neutralize and normalize interest rates. Okay, and I'm on the record because very specifically for long term, not for short term. But in terms of this, there were a couple of things that didn't make a whole lot of sense. Number one, how is the Fed still data dependent when they're projecting 2 interest rate hikes? That doesn't make a whole lot of sense to me. So why would you need to be data dependent, which we were data dependent for how many years, Tim? I mean, my goodness, we were data dependent from 2009 to 2017. We were data dependent. So the Fed is coming back to this, we're going to be data dependent, but we're still projecting. How can you be that and still project if you need to see the data first? So that didn't make a whole lot of sense. And I think the market got spooked on that. And the second thing when he was talking about was the balance sheet, that they're still unwinding the balance sheet, which is billions and billions and billions of dollars every single month coming back into the market, coming out of the market. And that creates a liquidity problem. Right. And so they didn't soften their stance on the balance sheet, and they didn't soften their stance in the speech. And although I do respect what Jerome Powell has been doing, that speech he gave yesterday was at best an average Fed speech, and at worst full of, hedging and hedging and hedging and hedging and hedging. And well, if A happens, then B, then C, then D, and then the rest. So it was when he started speaking where you really saw that volatility. And I stated this on Twitter about like 30 minutes after the announcement when the market was kind of up into this range. I said, guys, watch out for 25.30. If 25.30 is broken, this market will sell off of that. And you saw 25.30 get hit right here. It stalled just a little bit. If you drop this down into the 1 minute chart, you can see it here. And I hope you guys are learning a little bit about this intraday analysis that we do as traders all the time. But as you can see on this 1 minute chart right there, Tim, okay, look how it stalls right there at 25.30. See this trade right here, this snapback trade, that one's a hard one to hit because this is really volatile. But then as it comes back down into that 25.30 level, This one's really easy to hit. You have that order right underneath that 25-30 level. It gets punctured, and look what happens. Boom, 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 boom. That's, so a lot of this happened was after what Jerome Powell was kind of talking about, and then you just saw the reaction. And Tim, it was swift and it was across the board, and you absolutely have broken support levels. If you look at that on the daily chart, that's ugly. If you look at this on the weekly chart, Tim, that's ugly. If you look at this on the monthly chart, let's go out to a monthly chart. That's ugly.
Mm-hmm.
So I don't know what else to say. And I said this on Facebook to the people, family and friends. Get control of those retirement accounts, guys. This is real. Now, Now, can it snap back? Absolutely, 100%. Can the Fed come off if the market goes down another 10%? We officially enter bear territory in the S&P and the Dow and the NASDAQ, not just the Russell. Could the Dow come off that projection? Absolutely. Could they pump in billions and billions and billions of dollars back into the market? Absolutely. But they didn't indicate any of that yesterday. And so, we're not going to call it an official bear market yet because we're not there. But this has every data point that we look at for bear markets. You're breaking on dailies, you're breaking on weeklies, and you're breaking supports on monthly charts.
Oil's in a bear market, small caps are in a bear market, international markets have been in bear markets for a while.
Half of stocks in the S&P 500 right now are in bear markets. Half of the 250 companies in the S&P 500 are officially in bear territory.
Well, who came up with the 20-25% anyway? I mean, that seems like an artificial designation. I've been bearish for a long time. So,
yes, we've been bearish for a while, but no, it's just the official categorizations, right? For example, we're not in a recession right now, not in any capacity.
Not close.
But we see a recession coming, right? So we see a recession. Well,
what's interesting? And you and I were talking about that. It's very possible we could have a bear market, no recession. You got to have 2 quarters of negative GDP growth, Matt. And we do have strong employment.
Late 2019, at the earliest, late 2019.
You could have a bear market without a recession. It's very possible. Those things don't have to happen together. Now, they normally do, but they don't have to.
But they don't have to happen together. But again, remember what I was talking about with the dog and what you're walking the dog, right?
Mm-hmm.
So the economy, you're going in a straight line. Your dog, the stock market, is going everywhere it wants. It goes in the same direction, but it does different things in different time frames. When you're looking at a recession, you're right. The stock market will be bearish before a recession is announced. In fact, the stock market might start recovering while we actually go through a recession. Just look at 2009, Tim. The market topped out in 2007, broke weekly support levels in late December, early January of 2008. And you started seeing massive volatility coming down throughout the entire 2018. You had a kiss of death in April of 2008. You had a kiss of death. Okay. Mm-hmm. And at that point, you're only down 7%, and you're sitting at one of the biggest bearish formations and biggest shorting opportunities ever. And the official recession didn't start until October of that year. So the market's going to lead this. The market will go down in front of a recession. It's not like a recession is announced and then the market goes down. No, traders are going to start projecting. They're going to start pricing things in. And if you're the banks, if you're the institutions, if you're the hedge funds, and you see these types of things, you're not going to you're going to turn your algorithms around. You're going to start selling this stuff.
For sure. Let's break down some of these individual companies, Matt. One of the big gainers on the market today is Newmont Mining, some of the mining stocks that are sensitive to gold and copper prices. Gold is breaking out here today. We'll get into it here in just a minute. It's been rotating back up. I like Newmont in general. Still got the 200 to fight with like gold did at some point, but nice little green candle there today. Vertex, HCP, PPL, they round out some of the top 5. The advanced decline line on the S&P is about 100 to 400. It's been bouncing around there, mostly a bear market today, down 1.3%. 33-point move on the S&P just is not that big a deal anymore. We see it too often. We're down 1.3. If the market stays bearish, usually those things fade into like that 1.8, 2.2%. But who knows down here, obviously in the bottom, we're going to be watching it throughout the day. Conagra Foods, Carnival, CCL, give me that one if you would, Matt. Down 10% here today. And earnings missed.
Well,
CAG down
and I do want to say one
14%.
thing very quickly, Tim. Whatever the Fed did yesterday doesn't change the fact that we have a slowing growth environment around the globe. That doesn't change.
Yeah.
Doesn't change the fact that we still deal with the Chinese trade talks and the Brexit situation and Italian debt crisis. Those things aren't going to go away in the short term.
Sure. No, I agree with that 100%. And, we talked about it so many times through this halftime report. Oil falling is a bigger deal to the global economy than a lot of people understand. It's such a big commodity and how it impacts jobs and everything going on. It's not a small deal when you see an oil at $45 a barrel down $30.
I've said it more times than I can count when people celebrate getting 25 extra dollars that they're not paying on gas when people are getting fired from their jobs.
Right. That's exactly right. Some other major stocks that are in the news here today. Tilray is going into some kind of partnership with Budweiser, making cannabis drinks, Matt. Might be the perfect time for a recession. And if you are in fact losing your job, I guess, usually sin type stocks.
Well, think about it. Sin type stocks do decent. And and I'm not speaking to me specifically, but I get to get high and drunk in the same product.
I guess. I guess that's what's coming.
I think they're creating it literally for the recession. That's genius.
What's amazing about this whole push into medical marijuana is it does quickly spin into recreational products as well, obviously, and they are taking as much as they can from that. Budweiser also was a part of this as well, so that's an interesting thing.
Constellation Brands are spending $4 billion on research and development for liquid drinks, liquid marijuana drinks. I mean, it's a growth industry, no doubt about that.
That market is not going away anytime soon. Some of these companies are going to be very, very interesting to track and trade as we move forward over the next couple of years. Let's take a look at one stock that is back down in the red here today, General Electric. All is right by the world. Nothing wrong.
You're just happy. You got to be happy.
I don't have any positions on GE, so I don't really care, but it is a breakout right there. Trade it, Matt?
No, I'm not above 8. Are you kidding me?
No, I can't imagine that you would. Move on to the Dow, if you would. Give me the YM contract, almost identical to the S&P, in my opinion, from a chart perspective. But there is a key number down here, 23,000. I think we just pierced below today. Pretty precipitous sell-off. In fact, all of the gains for the year we are now in the red. And I know there are still 10 days left in the year here, and you have some trading days that it could snap back, have a bear retracement. But it looks like if the Dow ends in the red, all indexes will be negative for the year so far.
Well, I think I can officially say my prediction for the S&P in 2018 is not going to come to fruition. Right?
Yeah.
I mean, it's just not. This thing's not going to snap back. So enjoy the ride. Trade it.
Enjoy the ride. A couple of companies down or up today. Actually, there's only 3: Johnson & Johnson, Pfizer, and Coke. J&J coming back. Not a good sign when a stock that's been getting crushed by the news is the only stock that's up significantly.
Well, it's also in that category of Merck and Pfizer and Coca-Cola and McDonald's and Verizon and those companies that we've been talking about for the last few months, Tim, about how in this type of environment, those safety plays are beneficial. And, Johnson & Johnson, as you can see before the announcement came out that they were, killing people in the 70s. I said that for Cody again. I enjoy letting Cody know that. But until that, there he pops in. Until that happens, Johnson & Johnson was proven to be safety the same way Merck and Pfizer and McDonald's and Coca-Cola were. So,
sure.
It's not shocking that, Johnson & Johnson's up on a day where the market's going crazy.
Yeah, who knows with that chart right there. Obviously, it's news, and a lot of times.
By the way, we're only down 1% on the S&P today. So.
But it feels like it could and should get worse, by the way. I got to tell you, I'm looking at the heat map. I'm looking at companies like Microsoft down 3.2%. Walmart down 3%. Give me a quick look at Walmart, if you would. Significant company, in my opinion, especially at this time of year. You'd think they'd be doing well. They're breaking down, showing weakness. This is a major move here on Walmart.
Major break on Walmart.
That is a major break. And then you see Microsoft, which was one of the only bastions of strength in tech and on the Dow as well, now looking like it might be breaking below support here. I mean,
a close under 100 on Microsoft.
is significant. I mean, that's still a new trigger right there, Matt. So
Absolutely.
I'm seeing the 1% move, but I'm also, it feels like it could get worse and spin out of control here. I know that we're not a news driven day here today, but you're now coming off of the Fed meeting. All the stops are getting triggered and the bears are firmly in control at this point. There's no doubt about it.
Well, and for anybody that's missed the ride on the downside, there's going to be more. Okay. You don't have to chase things. Let things properly set up, pull the triggers when you see it.
Yeah, looking at the other internals on the Dow, the biggest loser was actually Walgreens. They're cutting costs down 5%. United Tech is down 3%, IBM down 2.5%. The Dow's looking pretty ugly here today. In fact, our advanced decline line is now down to 27 and 3. 27 companies going down. Move on to the NASDAQ, if you would. And pretty flat bearish across the board, 80 and 20 split on the internals. We're looking at a breakdown. That was a significant breakdown. In fact, when we were watching the Fed reaction here, Matt, when the NASDAQ went, I knew that the whole market was going, and it kind of led everything lower across the board. I'm looking at a heat map here. Amazon down 3%, Apple down 2%. A lot of these major NASDAQ names. In fact, let's do a quick rundown of the FANG stocks, if you would. Give me Facebook, which is actually holding up a little bit here today. They had
you keep mentioning the heat map. This is the heat map this week. This week, we got GE and we got AIG. You want to pick up either one of those?
Are they going to lead us into a new bull market?
No, they're not. They're not leading us into anything. You wanted to look at which one did you want to look at?
Let's run down the FANG stocks real quick. Okay. Facebook was down 6-7% yesterday, actually holding up a kind of a little doji green candle down here on the bottom. Still very, very bearish in general, though. Apple and Amazon next.
Okay. Facebook, keep an eye on 130.
Yeah, for sure.
Close under 130 could be a new trigger. Which one?
Apple.
Yeah, that just keeps going down.
It's been bearish. We've had this on the bearish option report several times over the last 2 weeks. And it goes to show the mindset of traders, guys. When Apple was bullish in the summer, we were bullish. And when it went bearish, we went bearish. That's what we do as traders.
We don't love the name.
Doesn't matter what the name is,
No.
It doesn't matter what the name is. I mean, GE was just as big of a staple in the economy and the market at one point as Apple is, but it went out of control. Now, I'm not saying Apple's GE. Don't get me wrong. I'm saying you can't fall in love with the name. It does not work that way. Amazon is next, down over 3%. This was on the bearish option report last weekend as well. And, we had some discussion about, this one. We knew a break below 1,600 was significant, down 150 points this week, about a 10% sell-off, Matt. That is some pretty healthy movement. And here's the thing. Another trigger below a triple bottom, there is no stopping point in the short term. I mean, you could point to that pivot back in March, maybe, but I wouldn't confidently think the traders are going to find that.
I think a break, and you got that support level on Amazon under, I'd put it 1,400 to 1,420 on Amazon. So close under 1,400 would be a potential new trigger. So undervalued right now in the short term. But again, this is what happens when you start getting emotional markets. They start going down and they go down past historical norms. So when you're looking at that, you do have a potential pivot right there about 1,350, but a 50-point movement on the downside, any swing trader would do that.
I'm looking at the option report from the weekend, which Mark was our guest here yesterday. He did the option report last weekend over at Tackle Trading, and I'm trying to remember where that first and second target were on Amazon. I believe it might have even been.
Well, the first target has to be right now. I mean, it has to.
From a week ago, yeah.
No,
1420. Cody, where did we put that target on Amazon? You and I were breaking that down last Friday.
I believe we did do a first one right about now.
Yeah, it has to be now. I mean, if you shorted this under 1,600, you got to be locking in some profit right now.
Looking significant.
Because think about it, Tim. You can lock in profit at a major support level on Amazon right now. More than likely it breaks it. Okay, but we don't know that. What you know is that you're sitting at a support level where last time it snapped right back 200 points to the upside. Okay, that's what you know. So if you're profitable on that short under 1,600 pulling off the option report, yeah, you're locking in profit. Absolutely. Yeah. You can always get back in.
By the way, that M is very clear. A break below this 1420, 1400 zone, wherever it is you call it, that's within 1-2% on a trigger. There's a lot more room down there. Obviously, we are down significantly here over the last few weeks. Amazon looked like it wanted to break and run up there in the 1700s. It's now down about 300 points.
Yeah, and Amazon in the last 3 months down 30%.
For sure. Netflix next, if you would. And NFLX 257 here, finding a support zone. That triangle actually did what triangles are supposed to do most often, and it ended up breaking in the direction of the primary trend. Symmetrical triangles can be hard to trade, Matt, at times because now you're just finding a new support zone. But Netflix here at 250, below that would be significant.
Well, and I've talked about that in the halftime report quite a bit. When you're dealing with these symmetrical triangles, the probability is the break goes in the direction of the primary trend, not the short term. So you have a short-term upward movement with a primary downward movement. The primary trend is dominant in that capacity. With that said, the trigger is the breaking out of the triangle, but me personally, I've never felt comfortable with that, Tim. I don't know if it's just my trading psyche or personality or whatever it is. I always wait for it to break the ultimate support level. And like I said yesterday, the only trade I trust right now is the breaking of support.
Yeah. Yeah, and you do have some stocks that are still looking at support zones and could break and run. I mean, the idea that we missed everything is not true if you start breaking down the individual opportunities.
People always think that, Tim. They always think they missed out the opportunity. And I see this all the time, is somebody misses out on an opportunity and then they just get so butthurt over it that they don't do anything about it, which means they miss the next one and the next one and the next one and the next one. No, learn, grow, succeed. Do it again.
I agree with all those things for sure. A lot of stocks here breaking down as we're looking at the market across the board. You know, NASDAQ, we looked at Netflix. Give me Google. That 1,000 mark on Google is one I've been watching for a very, very long time. And again, sitting on support, you know. Yeah.
You know what this trade reminds me of right now? It reminds me a little bit of the Tesla short under 250.
Mm-hmm.
Right? Never transpired. But you look at this on that weekly chart. You break those levels at 1,000. Yeah, that's significant. That's significant. A long-term head and shoulders formation on Google as well.
The best case scenario for any bullish trader out there would be that some of these big names like Amazon and Microsoft and Google don't break support and they hold it back into the moving averages.
Okay, but how long have we been saying that?
Yeah,
we've been saying that for 2 months. This market won't recover unless Apple, Facebook, Microsoft, Google, these names turn around, and they haven't. So yeah, if Amazon holds 1425 and if Google holds 1,000, and could that give some short-term support for the market? Yeah,
sure,
but not long-term.
You know, some of the stocks that did grab my eye here this morning were some of the chip makers. I still am waiting for Intel and Micron to start going back up and whatnot. I do like the idea. They're not showing me anything like that here today. MU down on the bottom, Intel down on the bottom. Applied Materials and AMD are two companies that we talk about all the time as well. They're just not turning around yet. In fact, they're weakening. AMD breaking into some support zones that are very, very significant.
All the chips are showing weakness right now.
Yeah. They look like they wanted to have some reversal characteristics, but this whole market's spinning around and just didn't happen.
And that's the thing. If the market would have held support levels and if we would have got some good news out of the Fed, then a lot of this would have transpired, but it didn't. You can't hope for something. You got to trade what you see.
Tesla down 3.7% today. You're a big Elon Musk fan these days, so it always interesting. You know, that support resistant thing, it is very noisy in between 250 and 380, Matt, but over the year, it has really held, you know.
Go back to what Jake Belly said when he was on the halftime report.
Yeah.
As Tesla gets into 340, 350, 360, I start adding put options.
Yeah. Yeah. And it's a better position style trade, obviously, because it takes some time for that thing to churn out and a lot of back and forth and volatility. But it is straight down here today, breaking below a key pivot point right now. Coming into a 200 period moving average, though.
I guess the market doesn't like that fake tunnel.
Well, I like it. I think it's pretty cool, actually. I do. Dollar index.
Wait.
The fanboys will celebrate that tunnel.
No, I gotta ask. How is a tunnel fake? I mean, a tunnel is just a tunnel. Whether you build it or not, it's a tunnel.
It's a good point, Cody.
It's a fake company.
Touche, lawyer. I like it. Make him clarify the language he's using. I agree with that. Is it a fake tunnel or is it fake news?
It's a fake company building a fake tunnel that won't actually help the transportation in LA.
With fake flamethrowers as well, remember?
Flamethrowers, yes.
But real debt
In the
obligations, I
in
will
the
point out.
they do have real debt obligations. Yes, they do.
Yes, they do.
Yes, they do.
As a matter of fact, they've had a hard time with that for a while. Dollar index, we were talking about that compression up there at the top.
We didn't get to talk about the
RTY,
worst.
yeah, definitely weak. Yeah. This was really significant to me. I got an email from a student here today, and she had mentioned that she was hedging her delta. And the way, Matt, that she was hedging her delta was to add more bear calls so that now she's oversized on the top side.
She's ratioed.
I guess. I mean, here's the problem. There's nothing wrong with the technique. I know that Coach Tyler talks about it as an alternative technique to delta hedging. But when markets are running like this, you don't use theta strategies to hedge.
Use theta to protect delta.
No, you use delta to hedge delta.
Delta to protect delta.
That's right. In whatever form and fashion it is. It could be a bear put.
I like her creativity.
Yeah, I do too. I mean, it shows critical thinking, right? But it's not the only technique to learn, for sure.
No, it does show creativity, right? And that is a typical thing to ratio something when you're concerned about the risk. But when you're talking about a free fall, right? Theta never protects delta. Okay. Delta protects delta. Delta protects theta. Delta protects vega. Delta, when delta is the risk, and delta is the risk a lot to theta, right? So when delta is the risk, you gotta tackle delta. It's not tackling theta. And by the way, I just want to give a good shout out to Coach Noah Davidson and Jessica Marino. They put together a absolutely wonderful video series on YouTube on all of the different option Greeks, delta, theta, vega, gamma, and they even did rho. They did 4.5 minutes on rho. I think that's a record on teaching rho. It was well done.
Here's my question: if you're going to break down rho, don't you have to break down Volga? I mean, where's my Volga video?
Are we getting the Volga?
I don't know. I've never looked at the rho number.
Getting to the Volga, that's like subtweeting somebody.
I get it. All right.
We had Jake break down Volga, and that will be the one and only time we ever break down Volga.
That's pretty funny, actually. In fact, I hadn't even heard that term. I think since I read the original option book, I picked up, and I ignored it then. By the way, yeah, c'est la vie. Obviously, stock markets are all down, very, very bearish. It's not the only market that's showing weakness, though. There's not a lot of markets showing strength. Gold is one. That is one. We'll get to the metals.
Can I say one thing to cash flow condors?
Sure. Yeah.
In an environment that is extremely bearish, obviously those bull puts are always going to be a risk, and you're never going to offset on the bear call what you lose on the bull put. You got to hedge. But if you're uncomfortable with doing hedging techniques, it is perfectly okay. And I've said this many times over the last few months, to go to cash, to wait till the volatility subsides, to get more confidence in that.
Well, of course, absolutely. Tyler even was blogging about that, I think, in the Tales of a Technician blog. He quoted Jesse Livermore, is that sometimes you got to go fishing. You don't have to trade every market all the time. There are times.
I'm fishing right now.
Yeah.
On this, I'm fishing on this. I'm waiting for the volatility to subside on the Russell. I haven't done condors on the Russell literally since I called it bearish all the way back here.
Yeah.
I just want to remind, that's what I called the Russell bearish. And since then, I just wasn't comfortable with the analysis on the condor there.
Well, and we've had a 400-point sell-off from top to bottom here in about 3 months. So it is pretty significant. I think pretty impressive, quite frankly. Markets have been bearish. They've been selling. Small caps have been leading us lower. Some areas that have been leading us lower have also been commodities. I want to talk about dollar here for a minute, Matt, if you would. $DXY. Obviously, when the Fed has an announcement, that's going to be significant. This idea that they're softening their stance next year, it actually put pressure into the dollar here over the last couple of days. Could not break the 97.7 handle up there on the top. Now it's more neutral to me. I'm not going to call this one bearish until it broke below support. I'm looking at this index, though, but I know you do our Forex report. What's your read?
A lot of what's going on the dollar is not necessarily due to the Fed yesterday, because the dollar actually appreciated on the Fed announcement, as it should. They were going to indicate more rate hikes than the market expected. Obviously, we were expecting 3. The market was expecting 0 coming into 2019. If you look at the Fed funds futures rate, and then they come in with 2. So it was a hawkish statement yesterday. That's what I want to say. However, you also had a central bank coming out today to announce monetary policy. And let's go to Forex Factory real quick. You had a central bank coming out today called the Swiss National Bank. and the Swiss National Bank decided to raise interest rates. And when they raise interest rates, that currency typically sees a little bit of price appreciation and other currencies don't. So, that's kind of what was kind of leading this charge here today. But the breaking of 96.40, like we talked about yesterday, if you see a close under that, you should see the dollar come down at least into that 96 handle. And some of you might be like, oh, that's only, 20 cents on the dollar index. Dollars don't move like stocks, guys. They don't move that way. That's just still a decent little day trade in the currency market.
Yeah. One thing that's moving even more radical than stocks lately is crude oil, Matt, down 5% here today, nearly. I think it's probably back up to about 4.5 or so. $2 move on crude is not that big a deal. In fact, you look at the candle sizes, it's kind of an average candle today, but we are down 4%. What is the ATR on crude currently?
Oh, Lord almighty. It's not going to be as big as you think, given the fact that we had that little slowdown here. ATR is right about 2.5. So, it's down $2 on the day from the top to the bottom on the daily candle. You're moving $2.50. So it's an average day. $2.50 is an average day. A 4% movement on crude is an average day in crude oil right now. What that means, not for the faint of heart. If you get a little, little scared sometimes, lights are out, you get a little nervous, don't trade crude oil. But for those of you that do enjoy trading crude oil, obviously we've been bearish on crude for a very long time. A close under 46, that to me is a trigger, Tim, with the target of 42, 43.
I've always maintained 45 is going to be a level, but a 46 trigger. I think you're looking at 42 to 40.
45 is going to be a level because it's 45.
Exactly. Every $5 mark on crude is always kind of in play. It doesn't mean it's the significant level that you anchor off of.
It's not like
pay attention to them.
For example.
Yeah.
Right. 50, that's a guaranteed trigger under 50. Like, for example, if support was setting up at 51, I wouldn't short it because of 50. I would wait till it broke 50. But if we're setting up at a potential short under 46, 45 is not going to stop me.
By the way, I want to point something out. About a month and a half ago, we had in my opinion, one of the more important halftime reports we've had in the last couple of months, when crude was breaking below 60, and we talked about the leverage and hedging against naked put options. Since that point, Matt, crude has now come from 60 to 46. We're down $14 more. That's about 25% more. People just holding on, hoping.
I hope people stop doing that.
C'est la vie, man. People are greedy and people are also emotional. When you're losing it, it is a very emotional thing. I've been there in markets before. I get it.
One of the hardest things to do as a trader is to take a loss.
I agree. Yeah, you've got to learn.
Loss.
Yep. You have to learn to take action. As I'm looking at the intraday markets, Matt, actually, the S&P, the NASDAQ, the Dow, they're all kind of turning over. In fact, the Dow just broke below intraday support. We're down 1.9% here on the Dow, 22,885. On the index, 22,884 here on the futures market. Continuing into the trend,
Watch this. You're breaking right now.
You are literally breaking below that intraday level right now.
Day trader scalpers and day traders would love that trade signal, by the way.
Yeah.
But come on, let's not be surprised by things. We have been talking about this for months now.
Oh, I'm not surprised. I would not. Nothing can surprise me in this market at this point. I will tell you that. When I'm seeing Johnson & Johnson getting drugged, no pun intended, into old
keep on that one.
Talcum powder news from 45 years ago and dropping 15%, it does not surprise me at all.
Well, and I want to make sure we're very clear on this, Tim. You're at the beginning of something here, not at the end.
Oh, yeah.
Okay. And this thing is not going to go straight down. That's never how it works. It's going to start a trend. It's going to get overextended. You're going to have snapbacks back into resistance. And we're just going to trade this over and over and over again.
Well, and I got something fun I want to run by you then, because I was reading an article and I want you to go back to the S&P or the Dow, anything on a big picture, like 20, 25-year monthly or weekly chart. I want to look at a lot of data, a lot of time frame, because today is Theta Thursday, but the markets have been selling aggressively. I don't feel like doing a naked put option, quite frankly. No. I don't feel like doing a cash flow strategy when the markets are showing me such significant risk. That chart right there, Matt, is as ugly as it was in 2007 when it was selling.
I think it's uglier.
It may be uglier.
Okay. It's not uglier in comparison to the October of 08. Okay. It's similar to the October of '08. This is the October, September, October. You see this one right there?
Mm-hmm.
Okay, that's that one. Let me look at the S&P. I always like to look big picture on the S&P. It's very similar. But you see that October, okay, from the very top of that 1176 to the bottom at the low, but we'll just go to the close. You're talking somewhere around a 20% decline in that month, right?
Mm-hmm.
So you're talking about this is the worst month we've had in December. This is the worst month we've had since 1931.
Okay.
Right? And hold on. I want to talk about something real quick. I keep hearing that. So worst month. I'm like, what? It hasn't been the worst month. It's been a great month. It's been a trader's dream. What are we doing? It's the worst month for permabulls, right?
Right.
But we're not permabulls. So,
well,
anyways,
most of the people are, by the way. So I think that's who they're talking to. I mean, when you're talking about
passive, hopeful, and whatnot, they're not. I don't even consider them people investors. But in terms of this, Tim, if you look at this, look at that. But come back to the very tops here, Tim. Okay.
Mm-hmm.
Come back to when it was rolling over here. Come back to where it was rolling over here. Okay.
Mm-hmm.
Now look at this. There's no rolling there, Tim. And the one thing I've said that I could not understand about the next bear market. And again, I just want to bring it back. We're not officially in a bear market in the major blue chips. But the one thing that I just couldn't grasp my head around is how is those high frequency trading systems going to drive the volatility in the direction of the market in 2018, 2019, 2020, whenever that bear market hit, in comparison to 08, 09 when it hit. Only and I don't know the exact percentage, Tim, but I think it's around 10 to 15% in 08 was algorithms, meaning all the orders coming into the market were algorithm-based orders. And after that, Tim, I mean, even into like 2010 when they have the flash crash, and then you had that, I forget the book's name off the top of my head, Flash Boys.
Flash Boys. Yep.
Yeah, Flash Boys.
Michael Cohen.
And even at that point, it was like 30, 40%. Tim, upwards of 90%, and Mark talked about this yesterday, upwards of 90% of this market is driven through algorithms, okay?
Yeah.
That have no emotion in any capacity. It just has traders managing the risk. That's all the traders do at those hedge funds. They don't click buttons. They manage delta and they manage risk is what they do. And you have now 90% of this market driven by that. I'm not surprised that we're seeing faster, quicker price movements, but it is a little surprising, I mean, to see how quickly it is in real time in comparison to what we went through in 08. And this is why perspective is so important, because I remember trading in 08, Tim. I remember trading the volatility of 08, and I remember it didn't get real ugly, scary, volatile until really kind of August, September, October of 08, right? You're seeing that at the top here, and that is a little surprising.
Which makes me want to remind everybody, though, Matt, out there in the halftime crew, it's possible that we could have an entire 2019 where it's kind of muddy waters, right? Where we're selling, but then we have 2 or 3 months back of rallying back into old support points. I've seen bear markets, and I've gone back and tracked the history of the market. 7 to 8, Matt, it took some time till we had that October sell-off, right? It was not immediate. You even look at 2000. It took some time before it completely, just hit the bottom. So it's not
about 2.5 years in .com. It took 18 months from top to bottom in subprime.
Yeah. So back on the overall topic, I was reading an article the other day, and this guy was talking about a few things that I don't necessarily track the internals on, but I thought it was interesting what he was pointing out. He said 5 signs of a troubled market that 2019 is going to be even worse than what we have in 2018. Number one, the short interest on the S&P has been going up, I guess, pretty aggressively. Measuring short interest, there's a ton of different chart indicators out there that you can, but traders are actually betting more against this market. Does that surprise you at all?
No, not at all. Yeah. What do you think? What do you think you and I have been doing?
Yeah.
And we're not the only ones, Tim.
You are seeing a lot of people pull money out of equities as well. Near record weekly outflow from U.S. equities and record weekly outflow from global stocks.
Oh, wait, Tim, just wait till Ma and Pa wake up when the market's down 30% and then they see where their 401k is, and wait till see how quickly they capitulate.
Yeah. Global stocks are in a recession, okay? Like the EEM has already been in a recession this year, FXI, and small caps are in a recession. And then here was the really interesting one. It's not just the Fed yesterday softening their stance on what they see and changing the tone a little bit. I guess the Bank of International Settlements came out, and they've had a lot of opinions about this as well. Everybody is seeing turbulence in 2019.
Well, I mean, that's how people go, though, Tim. They read what they see, and then they just project that. But I haven't done my projections for 2019 yet. We're not going to do that for another, 10 days or so?
Yeah.
10, 11 days. Can't remember when we decided to do that podcast. But I'm fairly certain my projections will be down unless I see something in the next 10 days.
Yeah. Yeah, I agree. Here we are on a Thursday looking at the end of the week, Matt. One thing to remind people, the end of the year can be a little bit weird. Now, I have no idea what's going to happen this year because you do have a shortened trading day on Monday. You have no trading on Tuesday for U.S. stock markets and futures markets. Now you have global Forex trading and whatnot.
And let's face reality, everybody in the world that actually trades is not trading in between Christmas and New Year's.
A lot of institutional players are going to have time off, take vacation, holiday, you name it.
They're all up in the Hamptons,
hanging
out, drinking some beer, talking about how they're making money, but their money managed accounts are underwater.
Right.
We've seen it before.
Sure. So what do you do? Well, you probably cover, you probably hedge. We've talked about, many different strategies: cover call, iron condor, naked put, bull put, bear call, poor boys cover call. On a Theta Thursday, one thing that I would like you to do is spend a few minutes talking about if you're going to sell a call option against a core equity position, how it can help you reduce some of your risk and control it. Okay.
Awesome. First and foremost, I just want to talk to everybody about in this market environment. And again, we kind of sound like broken records here as we've said these things over and over and over again. But in these types of markets that are seemingly starting to unwind, a lot of the aggressive stuff is coming out of the market. Defensive plays are advisable right now. But how do you protect, right, is kind of the question. How do you protect one of those long-term investments out there that we all have? We all have long-term investments, Tim, that we're upside down on. Would you agree?
Yeah.
Yeah, we all do. Okay. So how do we protect those, right? Well, number one, we can buy put options. Okay. We can just go buy put options to protect it, all that jazz. Number two, we can buy gold, right? And mind you, you can't buy long-term put options, in my opinion. You have to buy them short-term. And you got to treat them like a swing trade more than anything else right now. Mm-hmm. And that's just because volatility is here and you're paying a massive premium on long-term. And you've heard me give that analogy before where, if you're living in Florida and it's a bright sunny day and there's no hurricane coming at you, insurance premiums would be relatively cheap. But if you have a massive hurricane coming at you, insurance premiums would be relatively expensive. Well, we have a massive hurricane coming at us right now, and the market knows it, and the market maker's pricing that in, and insurance is relatively expensive. So if you're going to insure a portfolio, if you're going to insure a stock, the preferred method is to treat it like a swing trade. By 90 days worth of time, manage that over similar to a swing trade. So that's number one. Number two, we've seen other safeties, utility stocks. How long have we been talking about gold, right? Gold's coming back. Gold's a safe haven out there. Bonds have been pretty good. They're a safety play, right? They're a safety play. Number three, REITs. I've seen REIT after REIT, especially in medical REITs, okay, do fairly good. A lot of those medical REITs are up 6, 7, 8% over the course of the last 3 months versus the market down 12, 14%. You can go to cash. We've talked about that. Cash is a position in times like this. Mm-hmm. In good times, good trends, no, cash is not a position. Cash is cowardly, okay? So, number one, in good bullish times, cash is cowardly. Get it out there, get it working. In volatile, uncertain times, cash can be king. All right. Cash is a position in volatility times. Utility stocks can be a decent play, especially right now. Especially over the last couple of days, utility stocks coming back down into a support level. You're seeing upward movement in price off that support level. Utility plays, dividend paying, Verizon, Merck, Pfizer, Coca-Cola, Dr. Pepper, McDonald's, just to name a few stocks that have been performing fairly decent in this market condition. And as you can see with all those names, safety, cheap, utility, right? But let's say you're the trader and you have a long-term investment that you're looking at, right? And on most long-term investments that I do, I look to do covered calls on them as well. So let's take a stock. Let's take US Steel, for example.
Okay.
Everybody knows I like this company. Okay. Now, US Steel has been getting just beat up like everything else has, especially once it broke 25. Boom. Watch that. So let's say I own US Steel and I don't want to get rid of it because I've made money on it. I've been doing cover calls on it for the last couple of years. Everything's fantastic. Now, the topic I want to talk about is how to select the delta that we're selling. That's the topic I want to talk about. When you're selecting the delta, and the way the Tackle 25 is designed is we sell 0.40 deltas, right? In tough technical times, we add put options to collar the trade to ensure it. But when you're making a decision to sell that 0.40 delta, right? In a situation where we're looking at right now in the marketplace, an option you can do is you can be a little bit more aggressive with the deltas you're selling. So, for example, if I expect rapid growth in a company, okay, meaning i.e. I expect it to go up, it broke resistance, it was off a bullish retracement, whatever the expectation, I expect it to go up aggressively. Well, guess what? If I own 1,000 shares, I'm not going to sell 10 call options. And if I own 1,000 shares, I'm not going to sell 10 call options with a 0.40 delta. I'm going to take the growth. Okay. So I might sell 5 contracts at a 0.30 delta. That's called a ratioed covered call. When you own 1,000 shares and you only sell, say, 5 call options at a 0.30 delta, you're going to get growth and you get a little bit of cash flow. So you're trying to get the best of both worlds. But in times where the market is coming down, I'm not concerned about growth. I'm concerned about loss, especially on a company like US Steel that's just been getting just absolutely beat up across the board, over the last 6 months. I mean, this is a stock that's went from $38 down to $18 in the last 6 months. So in terms of that, to protect that investment in US Steel, what you can do is instead of selling the delta with the closest of 0.40, which would be the 35 delta here, and getting paid $65 per contract or offsetting 65 cents of loss per contract, what you can do is you can say, okay, I'm going to go sell a 0.47 delta. I'm going to sell an at the money option. I'm going to sell an aggressive delta because I expect it to come down, and I'm going to bring in my cash flow, at $103 instead of the 65. And so instead of offsetting 64 cents a loss to the downside, I am saying I'm going to offset, $1.03 to the downside. Does that make sense?
Yeah, of course. Yeah.
So not only adding put options to protect those investments out there, guys, it's not just that. It's making a decision on that delta, on that covered call, in selling that aggressive delta. And anytime I have a company, like the infamous GoPro story, Tim, I was selling, and when GoPro went from 29 when I bought it down to I believe I got out when it got to 8. When GoPro was going down like that, multiple months I was selling 0.50 to 0.60 delta call options, Tim. And as it was coming down, I would buy them back. I'd sell a 30-day contract, buy it back in a week, sell another 50 delta, buy it back the next week, sell another 50. And all of a sudden, 6 months later, even though GoPro went from 29 to 8, you're not showing a loss because you were aggressively managing that. Now, I would only do that if I was very good at covered calls, right? But that is a technique that you can add to your arsenal for those of you who understand the covered call in times of crisis to a stock, i.e. breaking major support levels, bad earnings, whatever it is, and you still want to own the stock long-term because you think you're 30 years from now type thing. You can be aggressive with that delta you're selling. So that's the technique I want to talk about today.
Well, and Coach Noah, I think he's done some training on this on our YouTube channel on the options playlist about doing in the money covered rights. And, you're talking about a 50, 60 delta. You could do a lot of different deltas. The original design of a strategy is based on original entry, right? But when you're rolling and managing and adjusting, there's a lot of different ways that you can affect the risk graph. I've said this for a very long time. Traders need to manage risk more often than they need to manage reward. At point of entry, mapping out how much risk you take on a day trade or a swing trade or a theta trade, or even throughout the management of it, and really learning how to hedge, adjust, and simply trade what you see, Matt, because US Steel is a great company, but when it's breaking down, it's very clear.
Technically, Nucor is a better company than US Steel, but I like you. Cover call. But I want to answer Marie's question. Yes, how to roll when US Steel recovers. That's the question. Okay, so especially if you're underwater, let's say you bought it at, say, $28, you've only done 3 months of covered calls on it, you've only offset, and you haven't been aggressively managing the net liquidation value, which means you've only offset 3 months of covered calls, which means you've only offset $3, which means your cost basis is 25, and US Steel is currently at 18.5, right? You're underwater. So if I sold that $19 call option and US Steel goes up to 19, I'm going to sell it at 19. Right. Well, my cost basis is 28. My cost basis was 25. I sold the dollar contract. So now my cost basis is 24, which means I'm still $5 underwater. And so Marie's question is, okay, but what if it recovers and the call goes in the money? Well, at that point, you would manage it fairly aggressive to the upside as well. And how you would do that is once the extrinsic value of the call option is basically lowered to 1% of the stock value, you start rolling that call option to the next strike price up and the next strike price up. So you basically keep on rolling it up in that capacity until US Steel gets pulled from you at that point. But even in that capacity, if it gets pulled from you at 19, buy it again and start doing it more.
Sure. I love cover calls. One of the things that we're working on when we've got our free time to go out and do creative and productive content, Matt, is we're building a video system on the Tackle 25 that should be coming out in January. I also saw an email, about our store in our inbox saying, hey, I see personal gold on there, but is it released yet? And I said, no, that's going to be next month as well. Probably even end of next month or so.
We're just working out some final details, and I know we've been waiting on PG for a long time here, but there's just some things we have to put in place first. So that will be coming first quarter next year, guaranteed. We're projecting third to fourth week in January for the launch of PG, and so I'm hopeful to hit that target, but it may be pushed back to the 1st of February.
Well, and here's the good news. While you guys are waiting for us to create more of those things, which we are always going to be doing, we love what we're doing over at Tackle Trading. System Development 101 was released for our pro members just a few days ago, Matt. And I've seen probably, quite a few students actually start that course, and we're getting good engagement there. If you've not started that course, go and take it, go through each of the modules and whatnot.
And we do so much from a trading perspective, right? Our scouting reports, our coaches shows, our coaches or the traders lounges, the cash flow club, all of our reports. I mean, all of that is just trading, the Tackle 25 with the cash flow list and whatnot, Tech 101, Options 101, Futures 101. What we wanted to do is we wanted to build a video-based system that was more on mindset, right? And that's what System 101 is. It is approaching trading and investing as a systematic trader, and treating this like a business, and the frameworks for trading plans and systems and so on and so forth. And I just felt like Christian did just a majestic job in putting that together, and well done to Christian.
Yeah. Quickly, give me the charts. We got at least a minute. By the way,
I just want to let everybody know, Christian was one of you guys at one point.
For sure. Yeah. He was a student. I'll never forget meeting and seeing Christian come into our community and being a part of it. Yeah. I did mentor Christian. One chart that is showing me strength here today is XLU, Matt. It does make sense that utilities would be rallying. It's one of the only sectors up. In fact, the only sector up right now. Bull retracement pivot trigger, actually. Not confirmed yet because you haven't closed above the previous candle.
Yeah. Okay. Last thing, guys. S&P markets all overextended to the downside, just broke support levels. We are slightly bearish on the market because it is overextended. But stay with us every day, guys. We're going to navigate this market. I don't care what happens. We'll navigate it.
A lot of interesting volatility. And one last peek at gold, if you would. We didn't get to it earlier, and I cannot go a day without talking about gold on the chart. Huge breakout. Yep. There is strength in the market. I mean, if you're the type of person that only sees things up, there are things that you can play up like gold right now, or you can go play an inverse ETF, Matt. That's always the old trick I used to play on students that couldn't figure out the downside.
Yeah. It's a trick because when you start teaching new students how to trade, they just don't understand shorting very much, right? And so you switch and you say, okay, well, let's go buy SDS then. And I go, yeah, let's go buy SDS, which is the exact same thing as shorting the S&P 500. Sure. Yeah, it's funny.
It is just what it is. All right, guys. Great job, Matt. Great job, Cody. We will see you guys back here tomorrow. By the way, Friday Fun Day. So let's hear from the halftime crew. What do you guys want to talk about tomorrow? What would you like to learn? We're going to put a poll out there on Twitter.
I thought we were doing
witching. What are we doing?
I thought it was quadruple witching tomorrow.
We've had a lot of requests. Probability of expiring cone, triple witching. I wouldn't mind talking about the RSI, Matt, doing an indicator deep dive. Bollinger Bands would be an interesting one for me.
Good RSI.
Yeah.
Volatility, trading volatility. I'll put a poll on Twitter.
Why don't we do a full session on the VIX?
Well, I was going to tell you this later on today, but I unfortunately will not be here tomorrow.
Oh, say lovely.
So you enjoy that VIX conversation.
We can do it. Well, then we can do the VIX.
You guys can talk VIX all day long. It's a worthless indicator you should throw in the trash, but yeah.
Put a poll on Twitter and we'll feel what the halftime crew wants to do. Cody, you can list out a few things. The quadruple witching one would be an interesting one. There's nothing wrong with that. I know probability of expiring cone has been one that people have asked about, so that could be a good one too. Yeah. All right, guys, we'll see you tomorrow.